Hey guys, welcome back to another video. Today we're going to be looking at the difference between a money market fund and a high yield savings account. I get a lot of questions about this and I've also wondered this myself, so I'm going to make a video today about this very topic. We're going to start off with Vanguard Federal Money Market Fund. I'm going to give you a quick breakdown and compare some of the differences between this money market fund and a common one that you would find on Fidelity. So let's dive right into it. The first thing to keep in mind here is going ahead and look at that expense ratio. So notice we're at 0.11%. That is what it's going to be out of $1,000. I'll let you do the math on that. But for a minimum investment, keep in mind this is $3,000. Now you can actually get rid of that minimum $3,000 if you open a brokerage account with Vanguard, and you can put any amount you want, as little as $1,000. Notice that 7-day SEC yield, your money is going to be compounding at 4.27%. Now also remember, this is a dependent number on where the federal government is borrowing money at their rate. Fed is going to change those rates every single year, sometimes multiple times a year, so that number is going to fluctuate. So now as we scroll down, we can see an overview of what this is going to look like, right? We can see what the minimum investment is, what the market return is, and a quick way to do it on Vanguard's website is go to performance and fees. We can see what this is looking like over periods of time. It's really nice because you can get an idea of what your money is going to be doing. Here's a benchmark, and here is where the fund is stacking up. We can do it by quarterly pre-tax or month. We can do quarterly, we can do annually, and we can do cumulative. So it gets you a good idea of what it's looking like. Now we can look at the price here. We can see where the portfolio is. What is the average life of this? And you can also see fund total net assets as of. See, that was basically at the last day of 2024. So we're sitting at quite a high number, 33.4 billion. All right, so let's go down more. Distributions, we can see what the dividends was paid and when it was paid, at what the yield was like. You can see the fund management and then a few other things. But I think the fund distributions here are really important because you get to see it visually. Okay, what is your money going to be doing and how it looks? All right, now that is Vanguard. We're going to jump over to Fidelity right now. Okay, so Fidelity is set up a little differently. The interest rate, or APY as they say, is not as great. As you can see, we're only averaging that right now. Our current 7-day yield is obviously lower than Vanguard, but there is no minimum requirement on these, which is really nice. You can put in as little as $1 and go from there. The thing to keep in mind here is you want to look at the 7-day yield and notice it's 7.06%. Okay, you can look at some of the other factors similar to Vanguard: performance and risk. What's the rating? Fourth thing, you can go through all of these. I won't go through every single one because there is a lot to read, but it's just so you guys understand what to look for. But remember something with money markets, there is no FDIC insurance. So theoretically, if the federal government defaults on its bonds or sovereign debt, you could technically lose money. The chances of that happening are unlikely at the moment, but something to keep in mind. So those are the two popular money market funds that are paying the highest yields. Now we're going to go look at two major banks that are fintechs, not in-person banks, and we're going to go look at that right now. So the first fintech bank I want to look at here is Wealthfront. They have the largest amount of FDIC insurance, up to $8 million spread through different banks, and they're offering a good interest rate. It's a little bit lower obviously than a money market account. We want to pay attention to why is that. Now the reason for that, in my opinion, and we can see here on the website, is look at that up to $8 million in FDIC insurance. Notice no minimum or maximum balance to earn 4% APY, 0 account fees. I think that's excellent. I think the only downside to this bank that I see is there are no in-person locations. Let's say you have cash or anything like that, it can get a little annoying, but that's about it. If we want to scroll down here, what's really cool about them is they reimburse you for ATM fees. So 2 fees per month out of network, and you can see that it's up to $7.50 each, and you also access 19,000+ free ATMs nationwide, and I'll let you guys look at that. So it really automates your savings. Sometimes I prefer banks more because you want to get paid and you want to invest as well, so it can act as both, right? It can act as a brokerage and it can act as a bank account. I personally like them, and it's just pretty straightforward. You can also allocate money to different things right here, as you can see. So you can do paycheck, credit card bill, interest earned, down payment. Pretty straightforward. They give you a really cool idea of what you would be earning Right here, you can just kind of play with that, right? And then scroll to the very bottom and see how they stack up and what they offer. So here's what breaks down as, and it's traditional banks and then high yield cash management accounts. Keep that in mind. The big thing for me here is I love that FDIC insurance, because if you go to a competitor like SoFi, which is another fintech bank, and we'll take a look at in just a moment, it's only up to $250,000. You have 8 million here. It's very difficult to find a bank that will actually give you that. So we're going to go take a look at SoFi, which is another fintech bank right now. So SoFi is another really great bank. It's actually based out of San Francisco, California. Their APY is exactly the same as Wealthfront at 4.0. And remember, this rate will change as the Federal Reserve will cut rates or raise rates. Just remember that rate will always be changing. Come down here, you can kind of see their balances and what they have. What are they averaging the national rate and so forth. And you can kind of just read this quickly. Something I'm not a big fan of is a lot of their information here is sometimes a little bit misleading in things because you have to read some of the fine print, but overall the bank is good. I don't use SoFi, but it's another option in case you wanted to go with SoFi. But my pick for best bank would definitely be Wealthfront. And something I'm actually noticing here on the website is, look at this, FDIC insured insurance up to 2 million on deposits through seamless network of participating banks. It's just a little fine print there, right? And we can actually go and learn more about it. But that's the thing with SoFi. They have a lot of fine print things. It's okay. Overall, I think Wealthfront is a better option. Let me know if you have any more questions on this. Please drop it down below in the comments. And as always, thank you for supporting the channel. Please like and subscribe, and I'll see you in the next one.